On my mind, gotta hustle and grind. Financial literacy always on my mind. I'm stacking knowledge, no time to waste. Gotta invest smart, gotta keep up the pace. I'm reading books, learning all the tricks, studying the market, making calculated picks.
What's good, everybody? It's your boy Reckless Ray and we are back at it again with another episode of Bag Talk. Or as I like to say, another Bag Talk episode. And today we are going to be breaking down my take on the fully invested starter pack. There are a few different content creators that are going fully invested. I'm definitely the new kid on the block, obviously. We started dabbling with this in December. It is now coming up towards the end of February. And I'm liking the system. It's a little bit counterintuitive, and I keep having like massive expenses come up that I'm able to handle, but it's pushing my debt load in the wrong direction. So it's just a little bit different because I am forcing myself through this first quarter, which means the first 3 months, there's just no backing out on this, which will be actually, or the first 4 months, there's no backing out for me. No matter what comes up, no matter what happens, I am staying fully invested. And I've got my starter pack on how I've done it and my thoughts on it so far. So we might be doing an updated starter pack later on. But as of right now, this is what I'm thinking and what I'm actively doing. It's not just thinking. I mean, we do the financial updates every month. It's what it is. With that said, I want to make sure you guys hit the like button on the way in. Definitely tap in for this one because unlike my normal ones, this one will not be as ranty. It'll be on topic ranty, but this is actually a value set. This is strategy. This is strategic. This is what I'm doing. This is actual breakdown of my ideology and my philosophy on how I'm handling my finances right now. Because I'm not at the mountaintop, I'm out here struggling with the rest of you trying to get through this financial hellscape we find ourselves in. So definitely make sure to like the video. If you've been here more than twice, definitely subscribe. You're definitely going to want to subscribe after you watch this. This is going to be a great one. And last but not least, for those, well, actually not even second to last but not least, those of you who are on mobile, give me some hype me up down there. It's mobile only deal. Hype up the video. And for those of you who are subscribed, you've already liked the video and are already a part of the Wolf Pack, my community over here. You're part of the tribe, part of the pack. Share the video, get me out of the algorithm. So we're going to jump right on into it. I'm going to breeze through this because I am being super productive today. And I'm going to the gym after this recording. So we gotta jump on into it. So first and foremost, we're going to talk about fully invested. So first of all, people might not know what being fully invested is or by definition what it is. So I'm going to break it down for you. Being fully invested, the ideology of it is investing all of your income first. Now, the average person, they pay all their bills. They pay everyone they owe money to. They pay their mortgage. They pay everybody else first. And then they tell you to save like 5 to 10% of your income if you're a real big saver. And that's just going to, help you be rich in 60 years or whenever they allow you to stop going to work and then slowly expire. Actually, it's not even slowly. Normally you're retired for about 2 years before it's over. So, that's one way to do it. Now, for those of us who exist in the current reality in the financial hellscape, we do not believe in having to work until you're 60 or 70 or whenever they decide to let you leave. We like to set our own terms. We also like to set our own prices. We also like to be able to, say, F this, I'm out. And in order to do that, one of the things that has arisen, one of the strategies, and now there's a bazillion different strategies. I think a lot of them boil down to getting to this point, though, of being fully invested. That is where you invest all of your money first and then pay your bills. Now, the obvious next question is, how does that even work? Well, you have to have income being generated off of the money that you're investing. It's that simple. There's a couple of different ways you can do that, but for me, it's been the high yield dividend space. Like, it's been working for me. Like, all I have to do is manage the account. It's a little bit of moving here and there. Probably takes me about an hour or two a week. And that's my side hustle now, because my side hustle produces more than when I was Ubering for the entire year and working myself to death at making 100, probably about 40 hours of obviously my work week, which is generally 45, 50. And then about, I'd say at minimum 25, generally about 30 hours of Ubering. And I make more money off my portfolio with 2 hours of management with the capital that I have in there right now than I was doing the other thing. So for me, that's kind of the gist of the situation. That's where the income comes from. And since I'm doing that, I am investing exactly 100%. It's like 80 in that portfolio, but I don't have any like cash outside of my brokerage account to like spend on things. So when I pay my bills, it comes out of my brokerage account. When I and like obviously I have good credit, so I have credit cards and stuff, so I can front myself money, but then you got to pay that back. And we're also using that to pay down the current credit card debt that we have. So it's just flipping the ideology of, instead of paying everybody else first, you pay yourself everything first, and then use the income off of what your investments are generating, and then use that to pay your bills. So that way you're constantly growing your wealth base. Now, the next thing that we go to is, why would you go fully invested and who is it for? Now, this is a combo because they're kind of go hand in hand. And I have a couple of different opinions about this, to be honest, because this wasn't my first course of action. But like for me, one of my goals is to get to a space where I legitimately do not have to go to work. I don't want somebody telling me, oh, you've got to keep this job because you got to pay for your house. You got to feed your cats. You want to go on trips. You want to keep that decent car that you have. You like a nice car, you got to go to work. I don't want to be in that space, because then you're functioning from a place of scarcity. You got to take jobs that you don't want to take. You're compromised from a moral perspective, because then you end up doing stuff for money you might not necessarily want to do or be proud of. People take jobs they don't like, and then they have unfulfilling careers. Fortunately, I don't have that problem. I don't hate my job. I hate having to go to it. The only part of the realistically, like when I think about it from like really just sitting and meditating on it, it's the have to. And at that point, it's like, well, you go get a different job. Yeah, but I'm going to have to go there too, which means I'm not going to like it. Like, so I've got to get to a space, first and foremost, for me personally as a man, to where I don't have to go to somebody else's business that they built, that they set up, and have to be there. I don't like that. So that's why my why for me is simple. I want freedom. Who is it for? It's for the financially responsible. Like, can you follow a system? If you have a credit card, do you immediately max it out? Are all your credit cards maxed out? If all your credit cards are maxed out and you live hand to mouth like a peasant, it's not for you, because you're going to blow this system up. Like, it's not something that you can do and be like, oh yeah, I can just spend even more money now. Like, that's not how this works, because A, the income's not consistent. B, it's very feast or famine. And C, if you're not following the system, you're gonna lose on both fronts. You're gonna spend all your money, then you're gonna have to liquidate your portfolio to continue spending money. It's actually gonna be worse than having credit cards because then you'll just have $0. And the second issue is, you're in control of all your dollars, so you do have access to all of your money. It's not like where you invest at work in a 401k. It's behind some magic wall, and technically you got to go through extra steps to touch it, which for most of you obviously isn't a problem, considering that you guys are borrowing against your 401ks to spend money that you don't have also. But at least there's an extra step there. There's no extra steps. So you have to be extremely financially responsible. The second part on the why is, it really fast tracks you to a point to where if you want to retire early, you want to be financially free, this is the quickest way to get there. Because, and not quick like, oh, you can do it next Tuesday, but quick as in everything that you're doing over time that they tell you to do from a financial perspective to build up wealth that you don't have access to. This is that on steroids. And you do have access to use the wealth, and that means you can actually quit that job that you don't want to go to every day. And you can do it in a faster clip, especially if you don't have the self-inflicted wounds of like children out of wedlock, child support, ridiculous student loan debt. And yeah, like that. Now, for those of you who are actual high income earners who also don't have those self-inflicted wounds, me personally, I would just go and do this exact system just out of Bitcoin and borrow against the Bitcoin and then pay the Bitcoin loan back over time and then rinse and repeat and keep buying Bitcoin. That's what I would do personally. That's what this system is going to evolve into. Bitcoin is a big part of the foundation of this system. And for me personally, and we'll get into that later in the video, but if I was like me personally, I make median, I'm a middle income earner. I'm a half blue collar, half IT. I go to work, put on boots. Some days I'm dirty. Some days have lacerations on my finger from playing with wire and doing IT nerdy stuff. But I'm not a high income earner. I'm not at six figures. I'm at six figures because of this system, because I have dual income. But I'm not at six figures. I'm not near six figures. So there's that. And this has put me on a trajectory where I started this a little over like a year and a half ago. And I've got 17 months left of having to go to work. So like I will be at an income threshold to where I should be at or past my current income. So I will have double my income at that point. And I will also be able to, so technically, because I could live fine off of my income. I can live comfortably off my income with the lifestyle that I have. Like, I don't need to have like a Maybach Benz. I don't need to have a bunch of stuff that apparently everyone on the internet has to have. Like, it's just crazy. But I do own my own house. I own my car. I know how money works, so I can leverage to buy assets. And yeah, so 17 months, I could technically afford to just stay at home borderline indefinitely. And we're overshooting targets to do that. So there's that. That's the why for me, because it fast tracks everything, which puts me on a trajectory to where I will be able to acquire more Bitcoin in the process, because I am now back to regularly buying Bitcoin or amplified Bitcoin exposure, which is another thing we love over here at Future Financial Strategies. If you're going to have a strategy, always tweak it, make it more efficient. Like, again, not next Tuesday efficient, but over time. And like, we've got 17 months left, which puts it like, a solid 5-year plan and getting into a space where you can go fully invested. That's a realistic timeline, at least if you're half decent at managing the account, because I'm not good at this. I'm a crypto bro. I buy Bitcoin, some Ethereum. Those are the things that I mess with. And that's the space that I came from, was flipping money and generating income in crypto. And I'm applying the things that I learned over there at warp speed to this, which is way slower of a process for me. So like, this is something that I find easy and enjoyable. So that's the lane that I've chosen. And the fully invested ideology just made sense. And once I tried it, I was like, oh yeah, I see how this works, because I'm paying off my debt. Even though I've had large expenses for the last 2 months that came up. I had to service my BMW. BMW service is ridiculous, especially if you service it the way that you're supposed to, if you're planning on driving it for 200,000 miles or actually taking care of the vehicle. So that was expensive. My phone broke. I had to buy a new phone. That was an expense. That was a large expense for me. So, the debt's gone in the opposite direction, but the portfolio growth and the foundation that I'm building is growing, exponentially outgrowing that, because all the debt's asset backed, which means if I were to need to, I could liquidate my entire brokerage account. I would still have some money left over, and I could pay off all my credit cards right now. I'm not doing that because that account produces money, and I don't want to give up something that's producing cash flow to pay something off now to have to build that cash flow back up, because it wouldn't be as fast. And generally speaking, when I do stuff like that, prices go up. So then it also is more expensive. So we're not doing that. We're trying to use this to pay it off. I do have one caveat to that is once I hit $60,000 in my income, the primary income account that we're working on right now, once I hit $60,000, I will pay off whatever debt's left, carte blanche, because if I go back down to 40, building it back up to 60 won't take that long. And at $40,000, I'm producing enough money to continue living out of the brokerage account easily and staying fully invested. So that is one caveat. Let's see here. So the strategic pivot. So I guess this would be for most people would be the when do you, how do you strategically pivot / when would you go fully invested? Now this one's kind of interesting because it's different for everybody. For me, I would say at about, and this is for me personally, at about $5,000 in cash value margin. And what that means is I can pull $5,000 out of my brokerage account, borrowing against my assets at any point, up to $5,000 to move over to pay off debt. And basically, I also don't touch anywhere near 50% of that. So as it sits right now, I use roughly at any given time about $3,000 of my margin, just to manage debt, move stuff around, because obviously the mortgage, the loan that we took to buy the BMW, and also have the extra money to put in the brokerage account to help pay for the BMW note. Those are large bills. My mortgage is a large bill. Utilities are generally a large bill. Paying down credit card minimums, managing that, and then chunking at whatever card I'm focused on. Also large bills. So I use about $3,000 at any one given time. I have access to fully about $25,000 in margin if I were just buying stocks. They'll give me up to about $25,000. Since I'm not just buying stocks, though, the amount that I can get out cash right now is about, I think, it's about $7,500. And I don't like to use over 50% of the cash that they'll give me. So if I only had $5,000 in margin, I could make it work with $2,500. Like, I could make this system work with that. That's for me with the expenses that I have. And that's predominantly just because of the outstanding consumer debt. Not blowing money at the club on bottles and stuff. We've had surgeries, and also I used debt to originally spin this account up when I had my surgery. So I have my surgery plus the spin up from the original starting of the account. So I do rotate debt, and I did go through spaces as I was working my way towards getting fully invested where I just let myself run up debt and just managed it paying the minimum. So as it sits right now, we're at about 30. Yeah, we're back up to $30,000. And it was about 32 when we started paying this down. We got down to about 25, and like now we're back up to 30. Just expensive stuff happens. It's what it is. So we're building this account out. We're building up the income. But the strategic pivot for me was I started paying a bill at a time. And so then I was building the account up. And as I'm paying the bills, I'm like, cool, like I'm going to pay this one thing out of the brokerage. Then it was like anytime I got extra money, or I could leverage one of my credit cards to pull cash out of my credit card and put it into my, anytime I get checks, because like every once in a while I get, oh, that's not it. I get these bad boys from Citibank, where they give you the check. I don't know if you guys can see that, where it's like more time or lower rate. These are actually checks that I get from my credit card. It's one of my ones that I use for balance transfers, but since they send physical checks, I can just deposit them myself to me. Then I just get cash. So I do like that style of balance transfer because I'm in control of the money and it's great. So I'll use stuff like that to spin up brokerage accounts. So, I can pull out about, $10,000-$15,000 at a time doing that every 10 months or so, which is how long I normally allocate myself to pay those back. And, during tough times, I've used that to spin up this brokerage account. So there's that debt sitting there as well. And the account is now above the amount of total collective credit card debt. So like if I paid off everything right now, I'm sitting at about 40, I'd have about $10,000 left. Now with $10,000, I couldn't be fully invested. I would have to be like cash value fully invested, and I wouldn't be able to produce enough cash off of that to where it would be even worth doing, to be honest. And then building it back up, even if I was no longer having to pay the debt down, it would take so long to like build that back up, even with it compounding. It would just be like it's a pivot that I would not want to take. It would set me back dramatically. So I'm not going to do that. But as we're doing our final debt rotation, the pivot strategically, if you have low bills, like if you don't have like a lot of excessive bills coming out and you can get, I would say you could, if I didn't have bills, the bills that I currently have, or well, honestly, if I was starting out, if I wasn't already where I was at, we'll go from this way. Strategically, you should be able to, under normal circumstances, if you don't have kids or excessive bills or a bazillion-dollar car note or stupid high rent, which everybody's rent's kind of high right now, but about $10,000, I think I could have made the move to go fully invested, because then you also have your whole paycheck going in. Now, if you're a high earner, there's a couple of questions about this that I've received. High earners, you could do this with Bitcoin or something else because the additional income is just going to put you in a higher tax bracket. I don't necessarily know that from a tax perspective, because like you are going to get raked over the coals from a tax perspective if you're a high earner and trying to do this, unless you're setting something up so that you can transition out of that high earning job because you hate it, which I totally understand. There's a lot of people who make a lot of money that go to these like 6-figure jobs and they hate going to work every day. They don't laugh at work. They work with a bunch of people they hate. People you work with are douchebags. They think they're important. And that's the reason I like blue collar work. I like my job. I get to laugh throughout the day. I get to tell jokes. I take a nap in my van. I get to work on computers. I get to play with really cool tech. I have a skill, marketable skill that can't be taken away. And AI is not taking my job yet, or anytime. They're not even looking at doing my job right now. Like, it's great. So, perks. And then, as time goes on, there's less and less competent people at it, and the rates do go up. So there's also that. There's also a lot of growth potential. So there's also that. But I think at about $10,000, like if I had to start over, all my credit cards were gone, and I didn't have the SoFi loan, $10,000 would be enough for me to go ahead and I could be out of my brokerage account and go fully invested, because I would have enough coming in every month to where if I was staying fully invested, there's enough going in to generate more income that I think I could make that work. And I would say that that's probably going to be a good target for when you can start looking at what type of margin you have and how much income you're generating, because utilizing high yield is the key to getting that income. And then the second thing that I do is I'm also using my long-term investments to help keep that margin up. So I have a few positions that are marginable, that are long-term investments. And as we hit those goals, those will get moved over into the primary income portfolio to help pad the margin, so that there's something that's not, well, most of my long-term investments are highly volatile, but it's still better than, the NAV erosion on the income part of it. And it's like, well, that's the thing. You got to manage it. But when you're using less than 50% of the cash you have available, you don't have to really I've never been in a scenario where I'm worried about being margin called. You just have to keep track of what positions you have that have margin available on them and making sure that you don't sell those. That is one thing that I would note, because I have nuked my account a little bit by not keeping enough stuff in there that was marginable, because some of the high yield things don't give you margin. So there's that. So the next thing we're going to do, I got 2 more parts for you for this. And if you guys like it, hit me down in the comments. Definitely ask questions, because I am totally willing to do follow-up videos if you guys want to get granular with this. This is just kind of a carte blanche overview. It's kind of a starting point, and I might go on some deeper dives into specific parts of this video. We will see. Just let me know in the comments. Like I said, you guys make the request, I'll do it. So what is my fully invested formula? Now for that, I'm actually going to go ahead and pull up my brokerage. And we'll go ahead and log into that. And so I'll go to the income portfolio. And I'm going to share this with you guys. At this stage. Yeah, that's perfect. Okay. So for those of you watching, I've got my Charles Schwab pulled up. Like I like to give the receipts. As you can see, the portfolio value is currently at $38,769.71, which every 2 weeks gets a cash infusion, which goes directly into these positions. Now, the way that I have my stuff broken up is in 3 tiers, 2 of which exist on the traditional finance side, and the other one is Bitcoin. So Bitcoin is the foundation. We're always buying Bitcoin or amplified Bitcoin exposure. That's the base layer. It doesn't move. I don't hold cash. I don't have dry powder. All my dollars are working, or they are Bitcoin. That is it. I get rid of dollars that are idle and I buy Bitcoin. That's just you see the cap, plan B. Like, that's just what it is. Like, that's my basis, and it's what I believe in, and my money is where my mouth is. So the other piece of this is our income portfolio. So now the income portfolio is the workhorse. So I have positions in here that I consider workhorses. They're usually the higher yield positions. They're the more volatile positions. They're usually the positions that are in red. So what we have is we have MAAY, which is Bitcoin related, because during this dip, this bear market that we're in, that's when I turn on the spigot and my Bitcoin exposure and purchases go through the roof. This is when I get positioned. So what we're doing is we're positioning for the next bull run, which means that a lot of my workhorse positions are going to be Bitcoin exposed positions. As it sits right now, we've just started doing that. The first position is MAAY, which is over by Granite Shares. I like Granite Shares for just pure income plays. They're great workhorses. You get no margin. It is what it is. We've got 1,037 shares of that currently, and I've got one more purchase coming in to get this up to the $10,000 threshold, and then we're going to let it ride, and we'll start in on the next position. We've got PLTW, but that was a position we sold out of. I use these roundhill positions, which do give a little bit of margin, for swing trading. Palantir, I was in position on that because you can hold these, and the way that I'm using them moving forward is I will pick some year-long swing trades of positions I want to be in on for the year, and I'm going to buy them for the year up to $10,000 and collect income, and then when it goes up 30%, sell out of it, and then work it from there. PLTW was not a position that I was going to stay in for the year, so I got rid of it. Just kind of what it is. Next, we have, I wish I could reorder these. I wish I could change the order that these sit in, because I'm going to do the workhorses first, and then we'll go back for the second tier of this. So the next one we have is Semi, which is a semiconductor ETF by Granite Shares. It has been performing well. I got it to $10,000, and we are above $10,000. I will cycle out of this probably at about 11.5. I'll sell off about $500 worth of shares and move them into a different position, because I like to keep these positioned at about $10,000. I'm learning my lesson. We don't put all the eggs in one basket. This portfolio, while it is income producing, it needs to be diversified. So this is my play at diversifying. Next, we have TSLW, which we were in for a hot minute, and I did not sell out when it went up. It was up 10%, and I thought about selling it off, and I didn't because I didn't follow my rules. And now we're sitting with it. We're actively selling out of it. We're selling about 25 shares a week, 25 to 50 shares a week, and moving that over to get our May position, because this also, the pay on it is super low. It's more of a cash reserve paying position, and yeah, hasn't been doing too well. Then we have our last workhorse, which is Ulti. We're back in on Ulti. And why? Because the income's good. Obviously, it's going to potentially have some NAV erosion. I've wrote it down twice successfully, and I think I'm going to do it again. As you can see, this one's sitting pretty flat, which is nice. We're here for that. We've got a little bit more headroom, but since this is performing so well, I'm kind of not worried about it right now. We've got it paying out over $100 a week, so I'm good with that. My priority right now is finishing off the May position. Then we'll work on Ulti. And yeah, so those are the workhorse positions. Ulti also gives great margin. So getting out of wpay, a lot of that went in to get this position set up, because wpay also gives great margin. I just hate how the funds manage. It's just a NAV erosion monster, and it's eroding faster than Ulti is, which is also crazy. So then behind that, I've got my cash reserve / margin stabilizers. So what we did at $40,000, when I crossed the $40,000 threshold, I went ahead and put the call out. I was like, we're going to start de-risking the portfolio a little bit, have some positions in here that are more or less. Oh, actually, let me turn this on until we get to $3,000. That are more or less stabilizing forces in the portfolio. So we have Stretch, STRC from MicroStrategy, pays monthly, sits at around $100, and you're getting about 12%. This is very boring, predominantly cash. This is what I consider my checking account for this portfolio. And we're back down to 3 shares because the last dip we sold off to buy some extra May on the dip. And yeah, that's what we did. So these positions I will sell off in market downturns to fund the heftier positions of the workhorses. Next up, we have QQQY, which is a weekly distribution ETF that tracks QQQ. As you can see, this position also not doing too bad. It's in the green. And it's a payer. So that's pretty nice. We've got drip on these positions. The goal is to get them to about $3,000 a piece. So obviously STRC would be the first thing to be sold off. We sell down to 1 share. I wait until I have about at least $500-$600 in here before I'll cash out of a cash position. QQQY is a weekly payer, also low distribution rate in comparison to everything else, because May is over 100%, Semi is over 100%, Ulti is about 70%, so it's a little bit lower than the other workhorses. But my 2 primary workhorses right now, both well over 100%, which is crazy degenerate territory as far as traditional finance is concerned. But for crypto bros, like, this is a walk in the park territory. It's manage it territory. And yeah, so that's what we're doing. And then I've got TSPY, which is from Tap Alpha, which is growth and daily income. Now, this doesn't pay daily, it pays monthly, but this is another one of those positions that I consider more cash than anything. Obviously, as you can see, also green. And these positions keep my portfolio from being complete nightmare fuel because they're stabilizing forces in there. So we'll get QQQY to $3,000, then we'll take the distribution from QQQY and reinvest it in the next position, which will be TSPY. We'll get that to $3,000. I religiously buy STRC every time I have my cash infusion. You always want to put something into the portfolio balancing. So it's 10%, which is normally a share of STRC, and whatever's left over from that goes into whatever we're currently working towards as far as our cash reserve positions go. And yeah. So that's my foundation. And then as I pull from here, because like as you can see, we're sitting at a deficit. We've got a little margin draw here right now of $1,476.88. It was at $2,076 as of last week, because that's when I did my second draw. We had some bills go out, and yeah, the margin as the income comes in, it just automatically pays this down, and then we get to zero, and then we reinvest a little bit, and then as the bills come due, we pull a little bit to get some Bitcoin and amplified Bitcoin exposure. Speaking of that, our long-term holds, which are all ugly right now, obviously, we're in the bear market. So I have Strive, we're down 25%. We're loading the boat on this. That is going to be a big part of our long-term holdings. We have MSTR obviously down, but we're trying to get to 10 shares. Once we get to 10 shares, this will be moved over into the income portfolio because they allow margin on this. SCHW, during the bear market, we are actively selling these positions off and moving them into ASST. That's just what it's going to be. Also for the SoFi, like I would just rather buy shares of ASST right now, or even 21. We have I will not sell my Tesla share, but I do want to get 4 more shares, and at 5 shares that will also go into the income portfolio. So if basically anything in here that's marginable is going to go into the income portfolio. ASST is not marginable yet, but once it gets there, that'll move over. But our play on this is during the Bitcoin bear market, we're loading up on the amplified exposure, and once we start running, we'll start pulling profits from these positions and moving them into solid state Bitcoin. The reason we want to do that is because once I get $20,000 in my Strike account, I can borrow against that, and then that'll give me some Bitcoin that's leverageable. I have my 1 Bitcoin is in cold storage. I'll never bring it out. That's not touchable. That's my retirement. So I consider my retirement fully funded, but like I want some Bitcoin that I can work with, because even though the interest is a little bit high, since I'm doing this cyclical deal, margining or leveraging my Bitcoin to build up my income portfolio even more, and then paying it back out of the income portfolio to pay off the Bitcoin loan, and then taking a little bit of that money and buying Bitcoin, because when I take out loans, I take 10% of it and buy Bitcoin right now. It'll be a self-sustaining loop eventually. That's kind of the goal. So that's my fully invested formula. I've got a little bit of a stipe part of my pay that goes and buys Bitcoin every paycheck. The rest of it comes over here, and we go fully invested in the income portfolio. When we pull out of our margin, we take 10% of whatever we borrow and also buy Bitcoin or amplified Bitcoin exposure, which would put it into this portfolio, which you're going to see this ASST position balloon up. Like I'm still trying to get my 250 shares of 21 Capital, but I will get my 10 shares of MSTR too, but ASST is undervalued right now based on their Bitcoin holdings. So I'm buying as much of this as I can. Like that position in particular, I'm trying to get as many shares as I can. Like my goal is 250, but like if prices stay low and we're in a prolonged bear market and I have a few months to crack at this thing, I could easily see me getting to 300, 400 shares, maybe even 500. I don't know. Especially with these price fluctuations, because every time I'm ready to buy, I check to see if they're undervalued against their Bitcoin holdings. And if they are, that's where the extra money goes. But yeah, that's basically what we've got. That's my fully invested formula. I got one more bonus for you. Best brokerage for going fully invested. Now, I use Charles Schwab. I like Schwab. I do. I like it because you get paid first thing in the morning. Like when the market's open, basically, I get all my dividend income at the beginning of the market so I can disperse it throughout the day. Which is cool. I like that. But I also have a Robinhood account. And I know Robinhood, they're like, oh, that's the kid investing, da 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 da. But look, for this type of portfolio, to be honest, if you don't want to have to call and negotiate margin rates, I would use Robinhood personally. And the only reason is Robinhood, if you're a gold member, they don't charge you any interest on the first $1,000. Now, keep in mind, me personally, I use about $3,000, which means I would only have $2,000 in margin anyway. That would be actively getting taxed for interest. The other thing is they have the lowest margin rates for if you draw cash out of your account. It's like 5%. Now, any other brokerage, if you can always leverage, I'll move my money. I haven't called Schwab yet. I need to call Schwab. I have not called them yet. I actually might just go into one of the local branches here because like we have local branches in my city for Charles Schwab to just get them to lower it. But I haven't done it yet. So like it's an additional thing to do. And if I just use my Robinhood account, I wouldn't need to. Both brokerages, you get your money in about 24 hours. Like Charles Schwab, guaranteed. Like I'll put in an order. If I put in an order while the market's open today, tomorrow morning, as soon as the bank opens, actually, I don't even know what time they update it online, but it's like basically first thing in the morning, you wake up and it's in your bank account. It was the same when I pulled money out of Robinhood. But Robinhood doesn't get paid during the day, so you get paid at night. So like if you have a payer that pays on Friday, instead of it goes in Friday night. Now, if you're carrying a margin balance, the other thing is it doesn't matter if you're carrying a margin balance. The only time it matters is if I'm running my portfolio flat, which means I get to invest the margin money. That's the only time that it actually, now that I'm thinking about that, it would actually, that the benefit of having the Schwab account is a benefit because I can get into the market that day with those funds. Robinhood, you do not get paid during the day. You get paid at night, well after market close. Like you are getting paid in the middle of the night session. I don't know what type of dividend deal they have, but all distributions come in after it's dark outside, which is fine if you don't need to be in the market that specific day. But the benefits as far as like using the margin and as a gold member, they have a bunch of other wealth services because generally speaking, these accounts end up blowing up. So like you got a little bit of something going on. They'll know you have some motion. They have a bunch of other stuff that you have access to faster than you do with the traditional big boy brokerages. But that said, I've had a Charles Schwab account. I've had it for a long time. And, you know, even though I wasn't using it when I started using it, I use it a lot now. It's very convenient ecosystem and it's easy for me to navigate. Robinhood also easy to navigate. The only my only complaint is like when they got paid, and like that kind of rubbed me a little bit funny when I first got into the high yield stuff, which was why I ended up favoring my Charles Schwab account, because before I was using margin, I was running my accounts flat. So I wanted to make trades that day when the money came in, and the money came in faster over here. But, you know, like when I call Schwab, if they don't lower the account, then I'm going to move all this money over there. Like I'll move it over to Robinhood and just get paid at night. And it doesn't matter because like I'm living out of my brokerage anyway. So that might be a little bit of a better ecosystem, especially since I use the Robinhood Gold card. It's my daily driver. The Robinhood card is. So like also there's that aspect of it of, you know, like it's super easy to move money from your brokerage to your Robinhood card. Also, like you also have that benefit. Charles Schwab has cards as well. The fees are stupid expensive because it's the American Express Platinum. And it's kind of that card's kind of expensive every year. So yeah, that's basically what I got for you guys. I don't know what else there is to say there. Like, I hope you guys got value out of it. It's a little bit ranty, but this is what I'm currently doing with my money and some of the stuff that I found interesting, and a lot of the questions that I have gotten when I talk to people about how I handle my investments versus them, because they're just like, oh, are you investing like 10%? I'm like, I invest all my money. What are you talking about? And they're like, all your money? Like, yeah, every dollar gets invested first, and then I pay everything else later. What's left, like with the distributions and stuff. And then that opens up a whole can of worms. And they're like, how do you do that? I'm like, well, you know, like you just take the little bit of information they got you and go down the rabbit hole, and you realize if I just invested all the money and I was getting some sort of income off of it, which is also possible now, then I could just live like that. And then the trajectory of how long you have to work dramatically shrinks. Again, have to work. It's not like there's plenty of people who will work because they want to. Working because you want to is different than working because you have to. And we're going to close it out on that. This has been another Bag Talk, the fully invested starter pack on future financial strategies. I'm your boy, Reckless Ray De Niro, and until next week, I am out of here.
Money on my mind, yeah. Focus, got no time for games, nah. I don't play, man, I'm all about that financial literacy. Investing in my future, building generational wealth. Dollar bills, they be calling my name, but I ain't chasing fame, I'm chasing change. Learn the game, now I'm playing it smart. Putting my money to work, it's an art. I'm stacking paper, building my own empire. No more living check to check, I'm getting higher. Investing in stocks, real estate, and more. Gotta secure the bag, that's what I came for.